Alrighty, so now we're going to actually look at a real chart. How do we identify where there is resting liquidity in the markets? Where are those resting orders? That untapped money that may be sitting there. Well, remember the bare minimum definition of where I will start to or anticipate that there is liquidity sitting below the market is when you actually have a low, right? A fractal high or low. So I won't be drawing on this time frame liquidity below the low of the candle. It needs to be this actual low here, okay? So again, I wouldn't draw the liquidity below that bearish candle because price has already tapped into it. It's not a structural low. This is where the low is. Likewise, that's where the high is. There's liquidity behind there. There was liquidity behind there. Just zoom out, right? That's the structural high. We move down, liquidity gets left behind there. There's untapped orders behind that structural high, and then price moves into those liquidity pools, okay? So this is, or what I'm going to do in this lesson is not really anything that systematic or that you're going to be directly sort of implementing into your trading or trade plan. This is just kind of going to be a very loose way of just scrolling through the charts, showing you where liquidity is and kind of just getting your eye for it. And like I said, as we go through the next lessons, that's when you'll learn okay, how do we actually now implement this and make it as a tangible piece of the systematic framework that I use and put it into your trade plan, right? So without kind of even drawing on structure and supply and demand zones, you can just zoom out and you can see what's going on here, right? Like we have, all of these relatively equal highs building along here. So we almost get that support level, right? People selling every time we come up here. Again, support and resistance traders going to be getting short. Tons of liquidity is building up here. And eventually we get that aggressive breakout to the upside as all of that buy side liquidity is tapped into. And then we get that aggressive retrace to the downside. And if you zoom in and kind of take that move apart a little bit within here, what do we have? We have that ascending trend line, right? That trend line liquidity building below those lows. So we know there's a ton of resting sell side liquidity below there, a bit of a mouthful, and then price comes down and taps into those orders. Then we've got, relatively equal lows here, right? Another support level. What do we know? There's resting orders below there. So then when price comes all the way below there, again, we get another bounce here, just generating even more liquidity. We get that triple bottom, people getting long, have their stop losses below those lows, and then price taps into that orders, it rebalances price, and then we get the pullback, right? So that's why we say every time we have a break of structure, what do we typically expect? We expect the pullback as that resting liquidity is then tapped into, right? Same thing again here. Start to build a bit of a range. We get sort of these triple bottom lows, tons of liquidity starts to build below that, and then eventually we get the breakout of that. Then what do we leave? We leave these equal highs here, tons of buy side liquidity is left above there, right? And eventually price will come up into there, and as price takes out those highs, just tap into it, right? Belly doesn't have to be a big tap, just enough, and then we start to see a bit of sensitivity as that buy side liquidity is tapped into. Even on a more granular level, if you really zoom into price, let's take a look. What do we get? Or even down here, right? We get that ascending trend line, people buying that trend line high, and then we get liquidity resting below that. Now, just because liquidity is there, we never know when it will be used, when price will tap into it. We just know that it exists, and at some point it may be used in the future, because as we can see, right, the trend continues to the upside. We have a fractal low here, so yes, that to me would be liquidity sitting below that low. As we can see, as soon as price just trades just below that, we get a sweep, and then we move to the upside. Resting liquidity above that high, what do we get? We get a sweep, and then we pull to the downside. Then we get a sweep of the resting liquidity below the most recent low, right? And then that fuels the move to the upside, right? So we'll talk about this a lot more in near future lessons, where we talk about sweeps of liquidity and how that can generate the continued moves. But essentially, when you see highs and lows like this, especially when they're kind of near each other, you can see you have that boxed off range. So people selling the breakout of their range, they get short. What happens? They get smashed as price trades back into the market. Likewise, people buying the break of this high here, if they got just tapped in trying to buy that, price trades in. So you get a lot of manipulation when that can happen. Likewise, price comes up here, we get a bit of a pullback, we move up, we failed to break the high. So this is a good example of relatively equal highs, okay? It doesn't have to be like a perfect double top, but you can see there's a clear move up and a clear move away, right? So you've got those relatively equal highs. This is kind of how I personally would annotate in the market. You can just leave a line there with a little X in it. Typically what I'll do, if I can be bothered to do it or if I remember to do it when I'm marking up my charts, is I'll just do that to show that the liquidity hasn't been tapped into, And then when price does move up and tap into it, that's when, again, if I can remember or be bothered, I'll put it in the middle to kind of show that the liquidity has been taken. And likewise, we can see price then comes back down, sweeps the resting liquidity below that low, and then we get a movement to the upside, right? Then price starts to pull back. We start to build that descending trend line liquidity, starts to build up here. Price then comes in, takes the liquidity above the high as well, fills up those orders, and then we get the pullback. And what did that move leave? It left relatively equal lows behind here, right? So we've got resting liquidity there. Price then comes down. Price then comes and sweeps liquidity below this low, right? I think you guys get the drill. There's liquidity everywhere constantly as price is searching for those pools of liquidity, searching for those untapped orders to fill up, rebalance price, and then fuel the move, fuel the next move that's going to occur from there. So again, relatively equal lows down here, relatively equal highs to the upside. Price comes in, taps those orders, and then it fuels the move to the downside. Grab the orders below here, right? And it fuels the move to the upside. But this is, as you notice, that's when we get the shift in structure. This becomes our strong high. We come into supply, right? We grab the orders and then we target the liquidity below that weak low. Okay, so we can start to bring in our other concepts and you can understand now how they all start to move together as we come in. We then get a break of structure. It taps into that liquidity below the low, fills up that sell side liquidity, right? And then buyers start to step into the market to push price back up. That's when we start to get sweeps of these internal highs, right, to then fuel the next move to the downside. Again, targeting the liquidity below that weak low to rebalance price. Price then starts to pull back again. Okay, so once you kind of start to see this, these same patterns happen again and again and again, right? We start to pull back, we start to grab the liquidity behind the highs until we eventually, fill up enough of those orders to rebalance price to then get that overwhelming imbalance between supply and demand, where supply starts to regain control, and then we start tapping into all of the sell side liquidity, and eventually the sell side liquidity below that swing low there, the external range liquidity. Again, this is concepts we'll talk about more in the future. I'm kind of being quite loose here, as I said it would be, just to kind of keep it relatively simple, but just showing you where those pools of liquidity are. Again, you can see relatively equal highs there. What does price do? It comes up and grabs the orders that that pool of liquidity that would have been sitting there, if you think about it as money, grabs that fuel, and that can fuel the move to the downside to target this weak low here, where again there'll be liquidity sitting below that low. You can see even just before it gets there, nice double bottom, inducing buyers into the market, more stop losses getting below here, taps into that liquidity, and then we get the movement again to the upside. And then this whole time, what do we have? That larger trend line building up so people can keep selling that, and eventually with that big trend line, what do we know? There'll be tons of resting buy side liquidity here, which the market then comes in and grabs, and then that fuels the next move to the downside, right? So yeah, I mean, even if you zoom out and do multi-time frame analysis, you'll be able to see loads of other things. You can even see here, right, without zooming in, we get this big range for a long time. What do we know? There'll be a ton of resting liquidity either side of that range as it's building up. So you'll get a bigger double top like that, price grabs the liquidity and then fuels the move to the downside. What do we have? Big trend line liquidity, the bottom of the range. We just know there'll be a ton of orders building below that, and then price grabs that, grabs the liquidity below the low there, right? Taps into that pool, retraces again, even within all of that range. Again, there'll be sweeps within that, right? All of these highs within here. You even get the exact high of the range as soon as that pool's swept into. What do we get? Aggressive retrace back inside the range. Liquidity sweep here, right? Taps into those orders, retraces back inside the range. Get a massive double top there, right? Loads of people who are short, where the stop loss is most likely going to be from these highs, or breakout traders wanting to buy that level because they think it's such a strong level with such a big movement away. They try and get long, and then both people who got short get stopped out, people who get long, they get tagged in and then stopped out. All that manipulation to then fuel the move there to the downside. Okay, so I'm not going to do any more than that because I think you guys probably get the idea of what I'm getting at here. But kind of just wanted to show you the bare minimum of where we anticipate liquidity being, within the market, essentially looking for those untapped highs and lows in the market. And now over the course of the lessons, we're going to learn how we actually kind of put together a more systematic and mechanical framework for what we look for to add to our trade plan, namely sweep zones and inducement. So yeah, let's dive into those in the next lessons.